Hello and welcome back. This is chapter 2 of our course, and today we are diving into a topic that's absolutely critical to your freedom and building future without taxes. Tax residency. And more important, how to exit. If you have ever wondered why you're still paying high taxes even after moving abroad, or how people manage to live around the world legally while avoiding high taxes. The session will clear up the confusion. So let's begin. What is tax residency? Most people assume that if you don't live in your home country anymore, you are not tax resident. Unfortunately, this is not that simple. Tax residency is a legal status that determines where you will be obliged to pay taxes. It's not just about where you live, it's about where a government believes you are economically and socially connected. Countries that use different routes to determine tax residency. The most common are the 183 days rules. It's almost 6 months plus a couple of days, or 6 months minus a couple of days. Couple of countries, it's 180. Couple of countries, it's 6 months. So the default is 183 days rule. Center of life test. Center of life test mean, for example, if you are a British citizen and you used to live in the UK, but you moved to Dubai, but you still have your company in the UK, your bank account in the UK, that's normal for the business. But what mean the center of life? Center of life is actually where you actually will going back whatever happened. If anything goes wrong in the UAE, you still go back to and live in the UK. Center of life, your family, your ties, your property, your investment, your long-term destination. That's called the center of life. And then ties to family, property, and financial assets, which could be bank accounts, could be investment account, stock accounts, property investment, your own family house or second property, and then your family, where you live, your family actually live, and then nationality or habitual abode. I mean, in the UK they call it tax dom or domicile. It's different. The terminology we use in each country is different, but normally it's depending on your citizenship or where actually you're going to live for the long time. So let's break this down in more details. The 183 days rule is straightforward. If you spend more than 183 days in a country in a year, you are considered a tax resident. No question asked. But many countries go further, for example. Under the center of life, even if you spent less than 183 days, you may be taxed if your family home or business in that country. And some countries like the US tax you based on citizenship, regardless of where you live. That's why American citizens have to take care extra steps to exit the tax system legally. So, hidden traps of tax residency. Now, here the part most digital nomads, entrepreneurs, investors, expats, immigrants, whatever you call yourself, global citizens, get wrong. Just moving to Dubai, Bali, or Lisbon doesn't automatically break your ties to your home country. You need to formally exit your tax residency. Let's say you are a current content creator from Spain and you move to Dubai or the United Arab Emirates. It's a country, Dubai is the city. You assume you are tax free now, but you don't notify the Spanish tax authority, or you didn't notify the German tax authority if you are German, or you notify the UK tax authority, HMRC, if you are British, and deregister properly, you may still be considered a tax resident. That means your total income could be taxed. And this also not just apply for citizens of that country. You could be, for example, a Moroccan citizen, live in the United Kingdom for 5 years, but you didn't get the British citizenship. but you have an indefinite leave to remain or like a green card in the UK, and you already registered with the HMRC, which is tax authority in the UK. It's the same thing. It doesn't apply here to your citizenship. It applies to your tax residency because you are already considered a UK tax resident, even if you're living in someone else, even if you are not a British citizen. This happens all the time, especially in countries that doesn't make easy an exit easy. Some of the countries make it much more complicated, especially in the UK and most of the European country. So what do you do now? Let's walk it through. How to exit your tax residency legally and efficiently. Existing tax residency is a legal process. It's not that you find someone influencer or someone you find on the YouTube. I'll follow this guide and he'll provide everything. Actually, every case is different. We'll try to make it steps by steps. It involves multiple steps and varies by country, but the general process look like this. Number one, stop spending time in your country. That's the assume the easiest one. Spend less than 183. If you, my advice, spend the less 3 months, 90 days. Most countries, especially the UK, Canada, and high tax jurisdictions, they only look to 90 days plus. Sometimes they look to 6 months. So stop spending time in the country. Number two, close local ties. Cancel your rental lease, sell or rent out your property, move your family, and withdraw from local institutions like clubs and membership. Any ties you have in the local that make you connected, even if you have to deregister for vote. When you move to a new country, you have to register for vote, but when you're moving out, you have to deregister from vote. Number three, close or change your business status. If your business is registered there, you will likely be taxed. Close it or move it somewhere offshore, tax free. That's another step you have to close your bank accounts and convert them to non-resident status. Most high tax countries, they have different status for bank accounts if you're living there. My advice, if you're not willing to go back to this country anymore, close the bank accounts. But it might be hard if you would like to open them back. And there is a trick called convert them to non-resident status. You formally inform the bank, I'm not living in the country anymore. There could be two issues happen here. The first thing, the bank could close your bank account because they say if you're not resident in the country, you'll not be able to bank with them anymore. Or they can move you to something called non-resident status. You will be having a bank account, but be you considered a non-resident. And this doesn't have anything with your residency or passport status. This is about dealing with the banks. Number five, the register from local health insurance, pension, and tax authorities. This is the key. You must officially notify the tax authority that you have left the country and ask for the certificate of non-residency if available. Many, especially in the UK, in Ireland, in Australia, in New Zealand, in Canada, they travel overseas to another low countries or keep traveling without a base. And then they keep using the health insurance in the country. They're getting access to the medical care they used to. They're getting access to the pension if they have a pension. They still registering with tax authority. They think that I'm already moved out. I don't need to actually deregister. Because if you're born, for example, in Canada, you will be eligible for the health insurance, the pension, and you already have a tax ID registered with tax authorities. But the idea when you get out of the country, you have to deregister for each one. Number six, establish tax residency somewhere else. This is very important because many digital nomads, especially after the lockdowns and the pandemic, they just say they keep traveling between countries, but they don't have a base. I mean, for example, myself, I have 4 bases, but I need to register or choose one of these bases to be used as a tax resident. I use Dubai as my tax residency, even I'm not living there all the time. So you need one country and you have a proof of this country. Many countries require proof that you are become tax residents elsewhere. This is called um, tiebreaker rule in tax treaties, that you are providing a proof. For Paraguay, they can give you tax residency. In Dubai, they have provide you tax residency. Some countries require that you live actually there, and some countries you just need to apply. That's it. Number 7, obtain and keep documentation. Keep travel logs, new lease agreements, residence visas, and tax residency certificate from your new country. Everything that you do in this status, you have to keep a copy. You have to keep a copy of everything. You have to make sure that all the information are right, and you will be able to work properly. Remind, it's not just about leaving one country, it's about arriving somewhere else. What if you don't exit properly? That's one of the most questions people ask. If you don't officially exit your tax residency, you might get taxed in two countries, which it's it's a very bad situation. You could face audits or penalties, or both, or one of them. Your offshore income might be considered a hidden income, so that could be you could go to jail, or you can have a penalty. You can have your money confiscated. So it's not something that you would like to have. You might not be able to open bank account and incorporate a business legally abroad. That's you could be put in the red flags on any side. Some countries use a lot of complications. Also, some countries are becoming aggressive with global reporting standard, like the CRS, Common Reporting Standard. Your bank, for example, in Portugal, may notify your old tax authority back home. This can create serious issue. You need to protective and plan your exit strategy step by step. So, number 5, where you should become a tax resident. After you exit, you will need to pick a new tax residency, ideally in a country that offer no or low income taxes, no tax on foreign income, simple reporting requirements, stable legal and banking system. The most famous destination that everyone is talks about is the United Arab Emirates. When you see Dubai, it's mean the United Arab Emirates. Dubai is the second largest city in the United Arab Emirates. It's not the capital. The capital is Abu Dhabi. And by the way, the United Arab Emirates, it's considered of different states or Emara. They call it Emara, like a state. And each state have their own rules. Most of them are tax free. Abu Dhabi, Dubai, Rak or Ras Al Khaimah in Arabic, and then they have Fujairah, Al Quwain. So it's and so you can use any of them, and they have the Fujairah. Sorry. So it's Dubai, Abu Dhabi, Fujairah, Al Quwain, Rak, and the last one I just forget it. So it's these 6 states, and then you can choose easier Georgia, Paraguay, Panama, the Bahamas, St. Kitts and Nevis, Santanawi, and there are special places like Prospera in Honduras. Honduras itself, it's not a tax-free country, but they have the special status in the island of Ratan. It's called Prospera. So we will discuss more this into coming details. Section 6, tax treaties and tie-breaker rules. If your country have a double taxation treaty, that's mean your country have signed up with another country that you'll not be taxed twice on the same income. Your new country may often use the tie breaker clauses to prove where you actually tax resident. These rules look at things like where you have a permanent home, where your economic interest ties, where you actually live, and your nationality. This is especially useful if you are in gray zone or with dual resident or with multiply passport like myself. So you have to navigate the complexity in order to use a double taxation treaty using this, where you have a permanent home, where your economic interests lie, where you usually live, and then your nationality. Here, real world examples. Case study. Let's talk about Adam, a UK citizen who moved to Thailand. He spent only 4 months in the UK, and so he wasn't the clear. But his business was still registered in London, in the UK and England. His UK bank accounts were active. His pension contributions continued. He didn't deregister for tax residency in Thailand. Guess what happened? He got audited. He was told he still owed UK taxes on his YouTube income. Only after he structured his company, opened a Thai company, and filed tax return locally did he successfully exit the UK system. That's the only way. It's not about following someone else. It's rules and regulations. It's a law. You have to understand you are playing by the rules, but you have to understand the rules so you can get the maximum benefit for moving abroad. So, I mean, key takeaways from what we have heard today about chapter 2. Tax residency is the foundation of international tax planning. You must understand how your current country defines it. Each country have their own rules and regulations. We talk as a holistic approach. Don't assume moving is enough. Exit formally and enter a new system. Get documentation and be proactive. Work with professionals if your case is complicated. Never shy asking advice. Don't look for influencers or YouTubers. I'm a YouTuber myself, but look for professionals who know what they are talking about. Global professionals. Don't work with your local accountant who just know one country. You have to look for professionals who understand the rules and regulations at a different country, and there are plenty of them. In the next chapter, we'll explore the top tax free country where you can build your life and business without giving half of your income to the government. Thanks for watching. If you have any questions, leave them in the comments and check our Global Expat where we'll have do weekly Q&A on the different topics. See you in chapter 3. Thanks so much for watching.